As I mentioned a couple of weeks ago, the sharp and sudden 20% decline in the S&P 500 in March was the worst on record. Achieving this decline in only 21 trading sessions, investors quickly adjusted valuations and expectation that COVID-19 would wreak havoc amongst the corporate earnings that are represented by the index. Note that this decline took only 3 weeks, whereas 9 months were required to achieve the same 20% decline in the S&P 500 in the build-up to the financial crisis, which started in late 2007. As businesses shuttered across the nation, another record was shattered. Here I'm giving you a look at a 50-year trend of claims for unemployment benefits. And what you see here is that previous to the pandemic, over a period of 50 years, never was there a case where more than 700,000 people in 1 week told the government that they lost their job and they wanted to collect their unemployment claims. By adding only 4 new data points, the shape of this graph is dramatically shifted to a flat curve. And this is what a 60x standard deviation event looks like. Said another way, in each of the past 4 weeks, 60 times more people than normal have lost their job and told the government that they need help. The shock to the economy isn't just in the labor market, it's also now evident in business. The Bureau of Economic Analysis reported a 4.8% annualized decline in GDP in the first quarter. Only a few weeks ago, many economists were still expecting a positive figure in the first 90 days of 2020. Unfortunately, the real figure eclipsed revised expectations, which suggested maybe the decline was only about 3 to 3.5%. The reason for the worse than expected contraction was a record decline in services, which is the orange bar, which is reflected here on the graph. Lower levels of travel, fewer haircuts, and meals eaten at restaurants outside the home all conspired with other services to perform worse than any period since record keeping began shortly after World War II. Fortunately, and I do want to give you some good news, services is an elastic portion of the economy that can snap back once normal services are resumed and consumers have the confidence to take advantage of them. Unfortunately, this is by far the largest segment of the economy as well, and a large contributor to commercial real estate use, and many of these services cannot be backordered. A meal not served in a restaurant can't be fulfilled in the future. And as long as my hair has grown over the past month, I only need to cut it one time to make it look normal again. That's why I'm not on video today. Given the decline in consumer spending on services, it isn't so surprising to see public companies lose their ability to predict their financial future. And because of this, nearly 2/3 of businesses in the consumer discretionary category and nearly 1/3 of businesses in the consumer staples category have withdrawn the financial guidance they typically give shareholders on their current quarter performance. This makes predicting the value of these companies and the rent that they will be willing or even able to pay in the future extremely difficult. But again, I want to give you some good news. In Washington, D.C., the response has been as dramatic as the decline in the economy. In support of investment markets, the Federal Reserve has contributed $2.4 trillion to investment markets in only 56 days. Where are they placing this capital? They're providing loans to businesses. They're buying bonds in the bond market. They're helping credit markets operate with a high level of function. Given that they've added $2.4 trillion in 56 days, we should all be very enthusiastic about this level of intervention, given that it took more than 4.5 years for the Federal Reserve to take this type of action in the wake of the financial crisis. Elsewhere in Washington, D.C., Congress has also committed an additional $2.9 trillion to households and businesses, with the $2.2 trillion CARES Act that was passed in late March and follow-on allowances of capital to provide to small businesses and households since that time period.